Hello, chart watchers, and welcome to this Thursday, March 15th Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's jump into the action. We're seeing the Dow Jones Industrial Average up 200 points, a little over 200 points today, and it is actually leading the market for the first time in quite some time. The S&P 500 up a little more modest, 5 points at this point in the day. The NASDAQ up 10. And the Russell 2000 actually in negative territory, down 3 points so far today. 10-year Treasury yield up 2 basis points to 2.82%. Industrials, a few minutes ago anyway, leading the sectors in terms of performance today, up a little bit more than 1% The XLK, technology, also having a strong day, as is healthcare, the XLV. Within healthcare, we do have the healthcare providers index, making a little bit of noise today, up about 1%. United Health, as of about 30 minutes ago, was the leading stock in the Dow Jones, having a very strong day today. Dollar General came out with its earnings, missed on the top line, missed on the bottom line, and is rising $5.64. Go figure. Actually, they did provide some upbeat guidance for 2018 as we head forward, and that is the reason for the gap up. And then finally, on the NASDAQ 100, Alexion Pharmaceuticals actually is the top stock. I think it's up about 9% or so today based on some positive news on one of its drugs. The second best stock in the NASDAQ 100, though, is NetEase. And I've got some interesting charts I'll show you in a bit on NetEase, but it is up $11 today, breaking above some pretty significant resistance at about 320. It'll be very interesting to see whether or not it holds into today's close. With that, let me bring in my co-host, Erin. How are you doing this morning, Erin?
I am doing quite well. It's a beautiful morning here, albeit a little bit windy for the morning, but we got sun today. So very much liking that. Had some rain yesterday, which we desperately needed here in Southern California. But
yeah, I went out this morning at 6:30. And again, I'm just into South Carolina, just south of Charlotte, North Carolina. And it was 26 degrees when I went out this morning at 6:30, and it's March 15th, and we're in the South here. So I'm starting to get a little irritated now that we've sprung forward. I'm ready to get out on the golf course, and this cold weather needs to go.
Yes, I think everybody on the East Coast would agree with that one.
Well, we have a special guest with us today, Julius de Kempenaer. And Julius, how are you doing today? First, welcome back to the show.
I'm good, Tom. Thank you very much. Hi, Erin. Hi, everybody. Yeah, I'm doing well, Tom. Amsterdam's got the same weather as you've got. We're done with the cold, and we need a little bit better.
Oh, is it still cold?
We had a few good days, but it's getting colder again. I surely hope not that we can skate on the canals again, because that really happened a few weeks ago.
Yeah, well, the market's been heating up. It's time to get the weather to heat up a little bit.
That's right.
Yeah, let's just leave it at that. We're going to have you back in about 10, 12 minutes or so, Julius. I know you've got a great
I'll be here
for everybody, so looking forward to that. And Erin, I'm going to turn it over to you and let you go through the weekly announcements and the agenda, and we'll get everything started.
Absolutely. Well, it's going to be, as always, a busy week, and next week's going to be great as well. So the winner of the choice, actually, for everybody, for me to do on my workshop, I'm going to be doing it on volume indicators. So I'll introduce you to my favorite ones and show you how to use them. Everything stock charts on Tuesday. I'm sure we're going to learn something about the site that we generally don't know about. That's an excellent segment. And then David Keller is going to be here on Wednesday. He's one of the speakers. It's going to be at ChartCon, so it should be very interesting. And for today, as we were noting, Julius is here, and he will give us a great RRG presentation after the technical news, and followed by the ever popular 10 and 10 to 1. And our first symbol is going to be Centene, CNC. So if you want to go check that out before 10 and 10, go for it. And then we're going to try out a new segment today called Point Counterpoint. And basically, one of us will take a chart that we are happy about or not happy about, and the other person has to take the opposite opinion. So if I'm bullish, Tom has to be bearish on whatever it is. So you'll get kind of a dual, a way to see a stock or some charts from two different perspectives, even if we really don't agree.
It'll be fun.
Mm-hmm.
All right, well, before we get into all this madness, let me go ahead and take the screen and take a look at some technical news. There's a lot of economic news, and I have to apologize. I realized after I went through the technical news yesterday, I never gave the economic news that came out yesterday morning, and there was quite a bit of it. So I'm going to give you a bunch this morning and also go over what transpired yesterday. But first, let's talk about this morning. Initial jobless claims came out this morning, 226,000 versus the anticipated 229,000. The Philly Fed survey, 22.3. Market was expecting 23.0. So a slight miss there, but it was more than made up for in the Empire State Manufacturing Survey, which came in at 22.5. Market only expecting 15.0. And then finally at 10 o'clock this morning, the March Housing Index came in at 70 versus the 72 that was expected. And February's housing index was actually revised lower from 72 to 71. So kind of a double dose of bad news for the home construction group. And as a result, I know home construction was struggling a little bit earlier today. Now let's talk about the economic news that came out yesterday that I failed to talk about. February PPI came out as expected, rose 0.2%. February core PPI also as expected, rose 0.2%. February retail sales dropped 0.1%. The market was looking for 0.4%. So a big miss there. But a lot of it had to do with the autos, because if you take the February retail sales less autos, the miss wasn't quite as great. It came in at 0.2% increase, with the market looking for a 0.4% increase. And then finally, yesterday morning at 10 a.m., January business inventories rose a bit more than expected, 0.6% versus the anticipated 0.5%. So with all that, you could see yesterday we did have that 10-year Treasury yield dropping down, testing the early March low at 2.80%. We've been talking ad nauseum about this sideways consolidation on the 10-year Treasury yield between about 2.80% and 2.95%. Well, we're in the lower area of that range of late, pulling back here. Although we are up slightly today, back to 2.82%, but really not much. We've been trading mostly sideways today with very little volatility in the bar. Let's go back a year, and let's get off of the candlesticks and go with a solid line chart. But I want you to take a look at how the NASDAQ actually was kind of taking a back seat to the Dow. Everything was going up, but the Dow was actually going up faster. And we kept commenting, you know, the Dow was hitting 22,000, a month later 23,000, a month later 24,000. It just kept going up and up and up. And part of that, I think, was the tailwinds because of the dollar. The dollar was declining throughout 2017, so those multinational, large behemoth companies were benefiting from a weak dollar. And so the dollar bottomed at the end of January, and since then, I still think the dollar hasn't really made up its mind yet, but based on some other indicators that we've talked about here on the show, I believe the dollar is going to head higher. And as a result, I think this is what's taking place under the surface of the market. I think money is rotating more towards companies that won't be hurt as badly in a rising dollar environment. The Dow Jones, many of those companies do a lot of their business overseas. So as a result, many of them will have some losses in terms of foreign currency translation if the dollar rises. And of course, the market's always looking ahead. So in my opinion, that's what's going on with the Dow. I could be wrong. But you can see this with the NASDAQ. And if I pull up the Russell 2000, even though the Russell 2000 is weaker over a longer term, in the near term, the Russell 2000 has been very strong. And you can see that coming back off of this double bottom relative low. This is the Russell versus the Dow. And there's been a lot of outperformance in small caps over the past 2 to 3 weeks. And I think this is really significant. I calculated the numbers, and since February 26th, the Dow has fallen 3.7%. Let me just pull up the Dow chart so you can visualize this. But here's where the Dow was on February 26th. We closed at 25,750 prior to today. Now, this, when I say down 3.70%, that was before today. we had fallen roughly 1,000 points since February 26th. And we pull up the NASDAQ over the same period. Look at where the NASDAQ was February 26th and look where we closed. We actually are higher by about 1% where we were just 3 weeks ago. And then throw in the Russell 2000, and we're actually up about 1.5% from where we finished February 26th. So there's been, you look and you say, well, we're just continuing to consolidate. Yeah, the NASDAQ broke out, but all the other indices are consolidating. You may not realize what's taking place under the surface of the market, but to me, I think it's pretty clear. Money is rotating away from the Dow, away from the S&P, and more toward the NASDAQ and the Russell 2000. Part of that could be the anticipation of a stronger dollar in 2018. Again, that's my story. I'm sticking to it. We shall see over a longer period whether or not that is in fact the case. But I think when you look at the Dow and some of the companies like McDonald's, I know McDonald's, you can see the huge drop. Coming back up, actually having a nice day, as are the restaurants and bars. That whole group, Starbucks having a good day as well. But it is down quite a bit. You can see it dropped from 170, almost 178, down below 148. And this took place over about 5 or 6 weeks. And so even though the market, many areas of the market were bouncing in late February and then recently breaking out to new highs, you can see McDonald's on a relative basis has not done the same. And there's a number of stocks that we could go through and take a look at. Look at XOM, ExxonMobil. Starting in February, we were at 88. Now we're back down close to 74. That's a huge drop, probably about 17% or so over the past 6-7 weeks. You look at some of the healthcare companies. Merck was up $63 back in mid-January. It fell down to 53 recently. Johnson & Johnson. I mean, the list goes on and on. Stocks that have not recovered very much off of that drop that we saw at the end of January and throughout the first couple weeks of February. So it seems to me like things are shifting a bit. Now, if we look more in the short term, I'm going to pull up the NASDAQ again because we talked about the 60-minute divergence. And if I pull up the hourly chart on the NASDAQ, take a look. Here was your higher. See how we keep going higher and the PPO keeps rising? Well, on this last high back on Tuesday morning, notice we didn't get a higher PPO reading. Higher price, lower PPO. That's a short-term negative divergence on these hourly charts. And what I look for at that point is for the rising 20-period moving average to no longer hold and for us to get a 50-day test. And at the very low today, that's exactly what we did. We got down to 74.73, and the 50-day right now is at 74.83. So we went down, we touched it. And so at this point, I don't think the negative divergence on the hourly chart is going to impact us as we move forward. That's just something I think you should keep in mind. The XLK, of course, this is a big part of technology. Same thing, higher prices, lower PPO, back down to test the 50 period, or in this case, the 50-hour SMA, and we have reset the PPO at the center line. I mentioned the dollar earlier. Let's take a look at the dollar. Actually, I'm going to go out to a daily chart. And we're at 23.55 right now on the UUP. The 50-day simple moving average is 23.54. So we are just trying to get a close above. We have not closed above that simple 50-day moving average since back in the middle of December. So the UUP is starting to strengthen. And when we went down and put in this equal low down here, you can see that the PPO had turned back up. If we get a break through the 50 and this PPO crosses the center line, we get a bullish crossover, that could bode pretty well for the dollar. And again, there's a lot of ramifications that we've been talking about on the show if in fact that does happen. Let's see, the pharmas, the Dow Jones US Pharmaceutical Index, DJUSPR, having a pretty good day, really struggling to get through 525. That would be a key level because if we pull up Bristol Myers, and pull this one up on that relative chart. This has been a relative outperformer. Sideways consolidation breaking out in February. Here's the pharmaceutical index, which has been struggling, but look at Bristol Myers relative to the index. So if we get a breakout on the pharmas, I think Bristol Myers would be an interesting play. You can see it's actually held its own versus the S&P 500, even though the index relative to the S&P 500 has been very, very weak. One other stock, I think I mentioned NetEase earlier. I want to pull this one up and take a look at it. Then we will bring Julius in. You can see that NetEase here is making this breakout off of this downtrend. I'm going to bring up a weekly chart. Well, first, before I bring in a weekly chart, notice that we had lower prices and a higher PPO, positive divergence. So we look for the center line test and we look for the 50-day test. Well, we got that, and now we're actually getting a breakout. This is going to be big because volume is already up near 1 million shares today, which is about average what we've seen over the past couple of months. So this is going to be a heavy volume day, and I think the question now is whether we hold this breakout into the close. I think it would be bullish if we do. And finally, my last comment here, well, I didn't want the monthly. Let's go back and look at the weekly. On the weekly chart here, take a look at the RSIs. I don't talk a whole lot about the RSIs, but anytime you get RSIs in that 40 to 50 zone during uptrends, it becomes very interesting. Back in 2015, you can see NetEase struggled. We got the RSI back in the 40s, and then we broke back up above some key moving averages and took off. Same thing in 2016. RSI hovered in this 40-50 range. Finally, we broke the downtrend. We took off. Come down here into December of 2016. Dip into the 40s. As we pulled back, we break back up above the moving average, and we take off. Finally, August, September, October in here, we had pulled back, and then finally we broke out and made a nice run. Maybe not as solid as some of the others, but a pretty nice run. And now here we are with this RSI back into the 40s, and now we're just starting to make this turn on NetEase. And notice throughout the entire period, for the most part, the PPO remains above the center line. That tells you you've got a pretty strong stock. So anyway, I wanted to point out NetEase because it is part of the internet space, and internets have not yet made the breakout over the January high, like software and like semiconductors. But it's a group to watch because if it breaks out, potentially you got a nice leader here with NetEase breaking out as well. And with that, I'm going to turn it over to Mr. RRG, Julius de Kempenaer. Take it away, Julius.
Hi, Tom. Thanks very much for the introduction. I believe Grayson or Zach was going to pull up the poll. Yeah, there it is. Yeah. That's interesting. All right. So the question that I asked the guys to pull up is how often do you use RRGs? And quite clearly, the majority says once in a while, which is good. Weekly 22, daily 15%, and there is still 13% out there that says what's an RRG. Okay, so we still have some work to do because we have to educate this 13% that doesn't know what an RRG is, and we'll have the people that do once in a while change it to weekly or maybe even daily. So let's go. Oh, by the way, Tom, can you remind me why I prepare anything for shows like this? Because when you were like 3 minutes in, I already had 5 ideas about how I could jump onto your conversation using RRG. So
that's the way it works for the live.
Okay, let me, Grace. Yes, I can grab the screen now because do you want to continue? Yes, I want to. My desktop, share my screen.
As you get into this, Julius, I got a question for you relating back to that poll.
Okay, go ahead.
Does it matter what kind of a trader you are as to how often? Because you were mentioning, you want to get those who don't understand it to start using it once in a while and then move to weekly and maybe even to daily. Would you suggest somebody who's, maybe a intermediate term trader, is it worthwhile to look at the RRGs on a daily basis, or do you think weekly's better?
Oh yeah, no, it completely depends on your investment horizon as a trader or an investor. I mean, I primarily use RRGs on a weekly basis because my horizon is a little bit longer, and I try to look for longer term trends. But if you're an intermediate term trader, looking at daily RRGs definitely makes sense to come up with some trading ideas or even double check whatever your own workflow gives you on an RRG. And I hope that we can get stock charts to add intraday RRGs to the system, so we can have like hourlies or 10-minute RRGs, and then it becomes very interesting because you can have trading ideas during the day. I always tell people that you should match the time frame on your RRGs with the time frame on your normal charts. So if you usually take your decisions on weekly charts, then you use a weekly RRG. If you usually take your decisions on a daily chart, then you switch to daily RRG. So yes, it definitely helps for pretty much any time frame. As a matter of fact, I know currency traders on professional systems who use RRGs down to a 1 minute basis. So they have an RRG showing a bunch of currencies updating every minute throughout the day. So yes, it definitely works. Having said that, I have like 2 or 3 sheets that I want to share with you, because the little educational part of the content of today, I thought about talking about the difference between open and closed universes. For the people who just answered the poll, what is an RRG? The quick definition is that a relative rotation graph shows you trends in relative strength, or trends in performance, pretty much the same, of multiple securities in the universe against a common benchmark and against each other. So be careful, they do not show you relative performance as such. I'm not going to dive into and explain what an RRG is and what it does and how to read it, because there is a very good section on RRGs in Chart School. So please go there. And if that doesn't help or doesn't give you any answers, then I'm very available either in Scan or on the Discuss below any of my blogs to which you can subscribe. I try to answer everybody, so please beware. And if you have anything, just put it in there and you'll get a reply from me. Universes are the groups that we are looking at on RRGs, and they can be open and they can be closed. And if I talk about a closed universe, that means that all the securities on the RRG are included in the benchmark. And we'll go over some examples later on, but bear this in mind. All securities on the RRG are included in the benchmark. So, for example, the 30 Dow stocks against the Dow Jones Industrials, that's a closed universe, because all 30 stocks make up that index. They're all included. Now, for an open universe, you have 2 options. The first one is that it can be a subset of the securities included in the benchmark. So if we stick with the Dow Jones, then, for example, these 30 Dow stocks, when you compare them to the S&P 500, it's an open universe, because it's only 30 stocks in a universe that holds 500. So these 30 stocks are all inside the S&P 500, but there are many, many more. And the second possibility for an open universe is that the universe includes securities that are not included in the benchmark. So let's say, I don't know, XLU, the utilities sector. If you take all the members of the utilities sector and you compare it to the Dow Jones Industrials, not all the members of the utility sector are included in the Dow Jones Industrials. So that's also an open universe, because it includes stocks that are not included in the benchmark. Now let's make that a little bit more clear by switching to the system. Oh, this is, by the way, this is just a little intermezzo. This is the free version of RRG on stock charts, and that's just showing you exactly what Tom just was talking about the NASDAQ overtaking the Dow Jones Industrials. That's what you see here. You see the NASDAQ turning around and the Dow moving away. And if we scroll that through time, we can see exactly the rotation as Tom described it while he was doing the introduction and while he was thinking that the NASDAQ was overtaking the Dow. There you go. There it turns, and you see the Dow falling, and you see the NASDAQ rising. So this is actually the free version. Even if you're not a subscriber to stock charts, you will be able to see this RRG. And the second takeaway from the intro that Tom was doing, because he made a point about the US dollar. Now, I could be very villain here and just a bit naughty and saying, okay, the US dollar, what is that? if you talk about the dollar is gaining, the dollar is losing. For me, the dollar is expressed in something else. For me, it's the dollar against the euro. Someone in the UK, it's the dollar against the British pound. Someone in Japan, it's the dollar against the yen. However, you can visualize that using an RRG, and you can actually do that on stock charts. What I pulled up here is an RRG for the G10 currencies compared to the US dollar. There's a little bit of a trick going on here. I won't go into details. If you want to know how it works, Google or search for one of the blogs. Maybe we do another session about it. But this actually underscores what Tom was just saying, because the US dollar is the center of the chart here. And here you will see all the other currencies. Now, it shows you that the dollar was weak, maybe still is, but it's turning around because the relative momentum of all these other currencies against the US dollar is falling, which means that the US dollar is slowly, it's not there yet, slowly getting stronger. Just to point out that you can actually look at this type of relationships on an RRG on stockcharts.com. Now back to the subject of today, to the open and closed universes. Here we have the RRG of the S&P sector ETFs compared to SPY. And this is, as we said, a closed universe, because all these ETFs together, they make up SPY. And what happens typically is that all the elements, all the securities, all the sectors in this case, are scattered around the center pretty much evenly. Now, there is an interesting study, and I will put that in one of my blogs one of these days. It's a study that was actually written by Matthew Verdell of Optima, and what he did, and because I was talking to him, and we were like, okay, now this is a closed universe, but it looks as if everything is a little bit skewed to the left. And the reason why that is happening is because all these sectors have different market capitalizations. Clearly, technology, which is right here, is the heavyweight in the S&P 500, where, for example, utilities or energy are much less in market cap, much less in weight. So when technology is over here, some others have to be further away to even it out, because when you do the calculation, and you can actually mathematically prove that all these vectors, if you imagine a line being drawn from XLU to the benchmark, and from XLB to the benchmark, and from XLP to the benchmark, from all these lines, and you add them all up, and these are obviously negative numbers and these are positive numbers, they add up to zero. It's a zero-sum game, and that's only because this is a closed universe, and that's why they're spread out. Now, another closed universe would be the Dow 30 industrial stocks. Let me make this a little bit more readable, like that. And by the way, what I do here is, because you see that this is heavily impacted by GE, which is far away to the left, very, very weak. So what I do to make my chart more readable is I tick off GE. I go back here, I say fit, and then I give it a little bit more space. And then, just not to forget that GE is in there, I put it back, and it will show up in what we call the gutter of the chart. So now you have all the 30 Dow stocks, and you can again see that they're pretty equally spread out over the chart. So there's a lot less differences in market cap in the Dow than there is in the sectors. Again, Dow Jones Industrials, all 30 stocks included in industrials, a closed universe. Now, another closed universe would be, let's see, what did I say? The XLU, where are you? Here. The utilities universe. Bring it up. You can see that this is pretty cluttered here. But this, again, these are all the utility stocks compared to XLU, which is the benchmark for the utility sector. if I now change XLU to SPY or $SPX, that's pretty much the same. Now watch what happens. Now we're going to change the benchmark, and all of a sudden, our RRG, all the stocks are positioned on the left-hand side of the plot. Now why would that be? Clearly because utilities is a very weak sector. If I bring back my duplicate, if I bring back my sector ETFs and I look where utilities is, far away on the left, and I look at all the individual stocks against SPY, it makes sense that they're all on the left. So this is an open universe. These utility stocks, they are all included in SPX, but there are probably 400 and I don't know exactly how many they're in, 475 of these stocks anywhere else on this plot. And then SPX is evened out. So this is an open universe, and this is a subset of the S&P 500. And now the third possibility is, where are you? Here. I go to asset classes. And this is interesting because here the universe holds more securities than are included in the benchmark. Now, the benchmark here is VBINX, and that's a Vanguard Balanced Index Fund. And that fund replicates a balanced portfolio, holding 60% in equities, 40% in bonds, government bonds. So if you make this a closed universe, I have to take away everything that's not included. And now this is a closed universe. And you will be able to see the relationship between equities and bonds against a balanced index fund. And you can see how nicely they are rotating over time. If you want to see a little bit longer history, you can put it at 3 years. I'm not giving everything back. I'll take that away. Max. And then you see the equity bond rotation over time. And please note, here you see there's a little while where bonds are overtaking equities. So here you favor bonds. And a while goes back, still favor bonds, or again favor bonds. Then it returns, and then SPY is taking over again, and it's pretty much stayed on track all the rally up since the early 2016 low. And you can see that it goes back and forth, but SPY remains on the right-hand side, so it remains to the right of IEF, indicating that you should prefer equities over bonds all the time. There you go. Now, here, this is interesting because SPY is still far away to the right, IEF is still far away to the left, clearly saying that you should favor equities over bonds longer term. But it's losing momentum. IEF is picking up, SPY is losing momentum. Interesting case would be to look on a daily chart. Like SPY, IEF. There you go. Now make it a daily. And now look at this, because this is interesting. SPY already started to take over on a shorter term basis. A little bit of a counter term move, but on the dailies, SPY is actually already taking over from bonds again. And that brings me to the next chart, or the one that I want to highlight, because I was looking at the IEF chart. And I think I like what I see here, because it looks to be bottoming out around 101. Probably has some space to 104, 104.5, these lows here. But on a relative basis against SPY, it's still strongly underperforming. this RS ratio is at very low levels, at the levels where it typically bottomed out over the last few years. So it's picking up a little bit of momentum, but it's not turning around. And that's exactly what the RRG shows you, especially on a longer term time frame. It's still far away to the right. So I still am in favor of equities over government bonds based on the RRG and based on the relationship between IAF and SPY. If we bring back all the other asset classes, and we now know that this is an open universe because there are more securities on the chart than are included in the benchmark. And that's, with this, you can explain, for example, why an asset class like real estate, like VNQ, can move so far away from the benchmark because it is not included in that benchmark. And if we take a little bit longer term period, we can also see that happening with commodities. Remember, commodities had a really weak period. By the way, if you click max and you start to rotate, then you make sure that everything for the whole period, in this case 5 years, is on the screen, so they don't scroll off the screen. Let's highlight commodities and scroll through time. And you can see that commodities at certain stages was completely detached from the rest of the asset classes. You see that here. See where commodities is compared to the rest. Really far away, and it continues to rotate on the left-hand side. Here we start. Weak, rotates back. There you go. You see that it makes a much bigger rotations around the benchmark than SPY or IAF. And it can only do that because it's not included in that benchmark. I already made my point about IAF. If I look at the relationship between IAF and SPY, then I think that that is still a very healthy relationship. So what you see here is the SPY IAF relationship with an RSI plotted, which is completely neutral. If you were to pick a MACD on it, just to look at some classical stuff, you can see that it starts to roll over and move up again. Ooh. You know who plays with 2-day RSIs? Larry Connors. It's pretty cool stuff, by the way. You see the rules up, it's neutral. So this relationship is, for me, still pretty positive, especially when it breaks above this level here, 2.75. And we'll have another big move in favor of equities. IEF is moving higher, means that interest rates potentially going lower. Not sure about that, but you know, it looks like it's bottoming out. So we've got some fresh fuel for the equity market. Now, let me quickly, because I saw 5 minutes, that's fine. How I work on the closed universe like the Dow Jones. This week I published a fresh blog on the 30 Dow stocks and how you can quickly scan through them. And I picked a few of those names to highlight. And what I want to do is just quickly have a look at some of these charts and toggle through that universe on an RRG. 30 stocks. There's the chart. Dow 30. And let's do something cool. Let's take a really, let's say, 20-week trail. We fit it. And then I'm gonna select Boeing. And now we can see the rotation of Boeing isolated from all the other names on the plot. Now I know that Boeing dropped rapidly over the last 2 days, I think. But what you see here, that it is based on relative strength and based on the RS ratio, it's still the strongest stock inside the Dow, and it's just losing a little bit of relative momentum. Nothing very major here. If I bring that to here.
Hey, Julius.
Yes, Tom.
One thing that might be interesting is showing how it compares to the Dow maybe on a weekly chart versus a daily, because the weakness that we're seeing here this week in Boeing isn't going to really show up too much on that weekly chart.
No, you're right. Well, we can easily do that. What I do is I duplicate the RRG and then switch to a daily update. And here's your daily. And then we want to find Boeing. It's clearly down there. And there's your daily weakness. And that started to, well, when I've got to be honest with myself, this is still, you know, every time when it rotates on the right hand side, look at this, that's just super strong. You know, all these rotations on the right hand side, we're already back in 2017 here, Q3, Q4, and then you see Boeing just rotating back up, strong lag, another rotation back up, strong lag, and it looked to be doing the same. Oops. It looked to be doing the same here, and that's on March 1st. And then it made a sharp turn left. And then from March 1st, early March, it started to head towards the weakening quadrant, or the lagging inside weakening towards lagging, which was like giving you an early warning signal. And now it just crossed over like 3 days ago. So yeah, you're right, Tom. That's so this is, you know, if you're a longer term investor in Boeing, you know, I wouldn't be too concerned, especially not if you look at the daily chart, because the way I read this chart is that we had this massive breakout of that range, super strong rally, super strong confirmation earlier in the year when we broke out of that already rising trend. I like that when the trend is rising and we take it out on the upside, so the rising resistance is being broken, you get an acceleration in the rally. We hovered a few times so that old resistance started to work as support. It worked last week, and now this week we're dropping back into the channel. And my rule, or what I've experienced over the years, is that when this happens, the odds for a retest of the lower boundary are pretty high. So my expectation for Boeing right now would be to probably continue downward. And let's put an expector on here. And this is where I call this double support, because you can see that the trend line is roughly around 315. And that spike low here in that week is also around 315. So that 315 area, I'd be looking for buying opportunities for Boeing in that area. So if we see some sort of a bottom coming in around 315, switch to your daily charts for a little bit faster recognition. Switch to a daily RRG, see if you see the turn on the RRG, then I'd be a buyer of Boeing around 315 if it holds there and puts in the bottom.
Yeah, this particular chart's pretty interesting because we've talked about Boeing a lot in the last couple of days, and I agree with you. I think that the weakness that we've seen in Boeing is probably, if not already, probably going to be setting up some opportunities on the long side with fairly tight stops, because I think that 315 level that you mentioned in there also is pretty strong support area going back at least in 2018 on these pullbacks. But I wanted to, you know, maybe for those who are watching and looking at RRG charts and trying to figure out, you know, how can I incorporate this into my trading strategy? I think what you just went through right there, showing how Boeing from a longer term perspective is one of the best stocks in this particular index. And then you pull a daily chart and you see that it's been weakening. Sometimes this daily weakness, even though it crosses over into that lagging side, can present an opportunity on a longer term basis.
Well, the way I would use this, I would use a daily RRG for this particular situation, is I would track Boeing on the dailies. And when I see it start turning around, like curling up inside the lagging quadrant, especially when it pushes back into improving in what I call a positive RRG heading. And heading, again, just search in the blogs, you will find it. It's the heading, like on a compass, of the tail. So the heading for Boeing right now here is, this is 180, that's 270, so it's probably like, I don't know, 230 or something like that. And what you want to see is a heading between 0 and 90. So when Boeing starts to turn around and the trail starts to gain on both axes, something like this here, like this is Walmart, it's starting to gain on both axes, that's interesting, especially if you have a 45-degree angle. That's super strong. That's what you want to look for. So with the strong weekly chart for Boeing, you'd be looking for an RRG heading between 0 and 90 on the daily RRG chart. I know it's my time. I quickly wanted to toggle you through these because there is one combination that looks interesting, or at least, you know, it's quite a cool site on an RRG. Cisco very strong, Nike not so much, JP Morgan, Microsoft really good, Intel really good, strong rotation. GE already turning around, so that weakness, this is, I don't like GE, still not.
I don't think we do either.
Right, okay, that's good. That's good to hear. This is Disney. Look at Disney. That went through improving, rotated back down into lagging. And where is my other? Here is Apple. Look at Apple and Disney. That is sales are Apple moving almost straight up, and Disney straight down. So what I now want to see is the chart of Apple versus Disney. And let's just bring up Apple versus Disney as a ratio. That's the quickest. And then what I see here is a super strong chart that just had a little bit of a correction. And if we take out that last relative high, this will make a perfect pair trade, long Apple, short Disney. Play it any way you like it, doesn't matter, but this is how I get trading ideas off of an RRG. This wraps it up for me, Tom, for now. I'll be around for a few more minutes, so you can take it away.
You're a regular here, so
yes, I'll be back from now on, definitely once a month. Yes, for sure.
Yeah, we get you on here once a month. You know, I always find the RRG charts to be very eye-opening because, first of all, you know, my background, I'm a CPA, so the fundamental side is where I got most of my background. But I started trading stocks and really was interested in technicals, you know, 2-3 decades ago, and I've just kind of self-taught, working with, you know, some of John Murphy's books and so forth, and the relative performance and being able to show relative ratios and that sort of thing was always kind of like one of the things that interested me the most, comparing stocks within a group to the benchmark and that sort of thing. And I think what the RRG does, it really makes it visual, where you can clearly see the rotation of a stock, whether you're long-term investor, short-term investor, whatever. You just pick your time frame, whether it's weekly, daily, and I agree, if it went to hourly or, you know, every 10 minutes or something, it would be very powerful for a short-term trader for sure.
Oh, yes. Yeah.
But I find it very visual, and I think probably a lot of our audience sees the same thing. Everybody always loves having you on the show, so certainly glad to have you as always.
Good. Yeah, I'll be here for a little while. I'm scanning through some questions on chat, and I'll try to answer them before I have to leave. But yeah, take it away, Tom.
Yeah, well, before you go, we want to talk about ChartCon because you're going to be
there. Yes, I'm going to be there for sure. Yes.
All right. So
yeah, I'm excited about it. I'm already you know, preparing my my speech and thinking about what I'm going to talk about, and
Where are
Chip asked me what my subject was going to be, and I had to. I think we all had to hand in our suggestions for subjects like before Saturday night or something like that, and clearly I didn't do that. So on Monday, on Monday, I pinged him a message and I said, you know what I would like to do? I'd like to focus my talk on 3 ways to use RRG on stock charts in real life. And but Chip already had penned me down for risk management using RRGs. So we're going to do risk management using RRGs in 3 ways on stock charts to do it in real life. So yeah, I'll be there, and I'm really excited. But we're gonna dive into an RRG. We're gonna do some advanced stuff, I hope, on this ChartCon, because I've done all the introductions. Everybody, in the stock charts community pretty much knows about RRG right now, and if they still don't, then they can go to Chart School or read up on my blogs that I've written over the past few years. So I really want to bring something new to the table for this occasion, and basically give everybody who attends stock charts a little bit value for their bucks.
All right, well, I got a comment here for you that I want you to think about for a second. 2 years ago, when we did ChartCon and I was sitting down, we were talking, I think right after ChartCon, didn't you go, you traveled around the U.S. and didn't you make it to Boston for a baseball game?
Yes, I did.
That's
all right. Was that your first baseball game that you'd been to, Major League Baseball game?
That was my first Major League Baseball game, and it was also my first major NFL football game.
That's right. You did that too.
Yeah, in one weekend. So go figure.
Yeah. Now, all right. I got to follow up on that, because in baseball, do you know what the closer is?
I have no clue, man.
All right. Well, it's the pitcher. Let's say you're winning the game 4-3, and you're going into the last of the 9th inning, and you need somebody to come in and close the game out. You bring in your best relief pitcher who comes in and closes the deal. Well, exactly. The closer in baseball. I just want to I don't want to put any pressure on you, but you're closing ChartCon.
Yeah, so that's pretty much a deal maker.
Yeah,
that's the one you bring in when you. Yeah. I have no pressure. I can handle that.
I'd like to think that Chip put you there because he knows you can kind of close the deal. But probably what happened is he didn't have your outline.
Yeah,
there you go.
So it's basically the story of my life. I just when I was in the service and the commander asked for volunteers, everybody stepped back and I was just sleeping and I was still standing there, and it was like, the Kempenaer, there you go.
There you are. So anyway, but the other thing we're doing, so the actual ChartCon is online for the majority of participants, but we're also offering VIP seats so that they can come join us. And I know you would probably agree with me that being there is just the best. I mean, I have so much fun just talking to you and all of my colleagues, but it's also really interesting to talk to our VIPs and see how they trade, what kind of questions.
Absolutely. Yeah, there are some super interesting people around there that I love to talk with and hear them out. And I always got a lot of good ideas from people who are actually using our stuff. So, yeah.
And then are you going to be going on the cruise that we have planned as well after ChartCon?
Erin, is grass green? Catholic?
Just make sure, everybody will want to know if you're going to go or not. But yeah, I think it's.
Yes, I am.
That's a bad analogy, because right now in South Carolina, the grass is not green, which brings me back to the point we started this show with.
Exactly.
Okay, is the Pope a Catholic?
Yeah, we don't hide, but the main thing I keep telling everybody is we don't hide in our rooms, that sort of thing. We're all out and about.
No.
You'll have somebody to talk to more than likely.
For sure.
Yeah. So highly recommend you check it out. We've got early bird pricing right now for the online conference portion. So you'll want to get that signed up very quickly, because the early bird pricing is going to go away. And pretty soon you will not be able to sign up for a VIP package. So they're going to be closing this out, I think, at the end of this month is what they had said. So March 31st is your final chance to take an amazing vacation. Great way to talk your significant other into coming to something like this. You can add on that cruise at the end, and there you are.
Cool. Before I leave, I'm scrolling through the chat and I see a number of questions that I don't have time to go into in depth. I'll ask Zach if I can get a copy of those questions.
Absolutely.
And I'll get back to them one way or another, either in a blog or I'll send you a thing tomorrow or maybe in the write-up or something like that. But I'll get back to those questions. Don't worry.
Yep, we get a download. So if any of you have put your email address in your profile on Slido, we will have your email address, and so you can get a personal reply.
Oh, cool. Yeah, I'll do that. No worries. No worries.
You guys have to add that to your profile on.
Yeah. Now, don't all 500 and something start writing me emails because it'll take a while before I get you your answers.
Yes, absolutely. Don't get too crazy now.
No, I'll be back next month.
All right. It's great having you, Julius. Always a pleasure.
Thanks, guys. Have fun. Ciao.
Wow. Excellent.
All right, so it is time to move into the 10 and 10. And
yes, before we do that, though, we did change up our poll. So I wanted to show people what poll we're running right now. Okay. And let's see, we'll go over here and see. But currently, we're asking everybody what their trading style is. So if you're a short-term trader, intermediate term. So if you just click that polls tab in the app, the chat app, Slido, to your right. And if you actually are watching the recording, we will have this poll up and running until tomorrow morning. So you can still get your vote in by using that chat app to the right of the viewer window. You have to be watching the show from the webinars tab, though.
Did you pull up the poll? Because I don't see anything on the screen.
Yeah, I think I threw my producer for a loop, so we don't have it to put up there right now. But yeah, go ahead and check out that poll. So we'll take a peek at it at the end of the show to see what everybody is saying as far as that. So, and with that, it is time for that 10 and 10. I know we've got that slide up. So first, I do have the results in my, let's see over here in the today's 10 and 10 chart list. So we can look at the RRG for that. There we go. All righty, quite a few today, quite a few. So if you wanted to look at these in different setups, you can do, of course, the RRG. You can check out the candle glance and all of that sort of thing. I'm going to see what happens when we change this to a daily, just because we're looking at some very short-term trades. So I'll fit that in so we can see everything. So real interesting, you know, at this point we do see two lagging. I'll be checking the chat box to see which was the most popular symbol request based on the likes very shortly, and that will follow up our first one, which is CNC, Centene Corp.
All right, let's pull it up. You know, I looked at this one, I already annotated it. I got a lot of mixed feelings on this one. I guess, you know, my overwhelming thought here is that we've got a nice uptrend that's been in play now for about 15 months up until late January. And we've pulled back and it looks like maybe a little cup forming. So I'm going to say overall I'm bullish, but I do think there are a few things on this chart that give me a little bit of concern. Number one, and perhaps the biggest one, is the breakout here recently in early January has come on very light volume. As you can see, really the lightest volume that you can, you know, throughout this uptrend, which is not great. It's just not giving me that great feel of confirmation as we move higher. The other thing is that we do have lower PPO with these highs. So I think a worst case scenario, or maybe at least short-term worst case, would be a pullback maybe to reset the PPO at the center line, which could take us back down to this key area around $90. I think that's a very significant support level. We did have a pickup in volume back in September and October, and we never had a weekly close below 90 with all that volume. So that's a key area I'd watch, and there's that 50-week moving average that we could test on the heels of a negative divergence. So 90 to me is kind of a line in the sand, but that's a longer-term kind of view of the chart. I mean, as a short-term trader, I wouldn't buy at 105 and hold until 90. So for me, it's probably this rising 20-week moving average in the near term that I'd be careful of. So maybe 100 to the downside. Look for maybe 111, 112 to retest the recent highs. And currently, we're almost right in the middle of that range. So I'm going to say it's just a short-term hold in a longer-term uptrend.
All righty. Let's see. It looks like we have a couple of popular ones. But I think McDonald's was one of the first ones that hit the top. So we'll go ahead and put MCD.
Yeah, we're in a bull market, so I expect that we're going to see many stocks, including McDonald's, participate to the upside. We did gap down, and maybe this is a short-term exhaustive gap, because after that gap on the heaviest volume that we've seen going back the last 6 months, we've seen really nothing but buying, and we are now back above the rising 20-day moving average. But overhead, 163 to 165 are going to be a couple of key areas for McDonald's to try to get through. So if I was looking at the stock with the anticipation or with the thought of maybe buying now, I would probably hesitate a little bit, because I do think the fact that we have now failed on 3 separate rallies between 163 and 165 makes me pause here to think about getting in at almost 162. So that's the part that bothers me. Overall, I like the market. I think we go higher eventually on McDonald's, but this could be a longer term on a weekly chart. This could be more of like an inverse head and shoulder, where we come down, put in a left shoulder, neckline, head. Maybe this establishes the right side of a neckline, and maybe one more pullback could be a buy on an inverse right shoulder.
All righty. Let's see. Let's do William Lyon Homes, WLH.
Yeah, this is my pick for this week. And it was doing great until the last 2 days with these housing reports coming out. And this is the other problem with being in a sector or being in a group, an area where you do have key economic reports that come out that very significantly affect a particular group. I mean, we could talk about retail sales reports coming out. It's almost like an earnings report for retail stocks. Same thing with many of these housing stocks. When we get these economic reports that come out throughout the month, they can also act somewhat like an earnings report, in that if we come in less than expected, like we did this morning with the housing market index, the whole group gets hit. So WLH, and I'm going to annotate this one in just a second, but if you look at the DJUSHB, you're going to see something very similar. The whole group is coming down, and as a result, we're seeing WLB drop as well. Now, a reversal today would be very bullish for the stock. Volume yesterday was just kind of average at best. Today's volume, I think, is pretty low as well, but I don't like losing this 20-day moving average, so I would like to see it recover by the end of the session. Now, as far as a key level, we did get up, almost test the 50-day moving average back on Tuesday. It was having a really strong day on Tuesday, but there is your price resistance. That was the reaction low here. Here was the breakdown. We gapped below it, failed to get through. We failed again in late February, and now just recently we made the breakout barely on Tuesday, and we've come right back down the last 2 days. And there was a bearish engulfing candle, by the way, off of a pretty nice uptrend. So it looks to me like the stock is probably going to go head back down and test this 25 area, unless we get a reversal today and can hold that 20-day. So that's what I'd be watching.
All right. Next one. I don't remember if you covered this one earlier today, but Apple.
All right, Apple. I did not cover it. I've been looking at it. I like Apple. I think Apple is a very strong stock, and I kind of agree with what Julius was talking about with the RRGs, not just relative to Disney, but relative to the overall market. I mean, we just saw Apple break out to an all-time high before printing that reversing candle. So I think here we could see a test of the rising 20, but I would be a buyer on that test. If you like Apple and you're looking for entry, I like the 20-day moving average as much as anything, because we do still have a fairly strong PPO, and you can see the last time we came down and approached that 20-day moving average, we bounced right off of it. So I think the Apple looks good. I think it's a great relative performer, and it's in technology, which has been the best performing sector. So this is the type of stock I would be looking to buy.
All right. In this technology space, continuing, Snap.
All right, Snap. Yeah, this one I've been trading pretty actively, and still have half of it. I think what we're forming here is a bullish wedge, and it's taking a while, which is very frustrating from a trading perspective. We had some nice strength off of that bottom when we pierced the gap support, top of gap support. We came right back off of that, ran from probably 1630 or so up to about 18.5. So it was a nice little pop, but we're now rolling back over. The part that keeps me interested is the fact that a lot of this is taking place on much lighter volume than what we had seen in the past. But the bullish wedge that I was referring to would be these declining tops, which continue to hold. And then if we take the lows here, you can see like this wedge off of the rise from earnings. So what you want is a volume. I want to see the volume start to pick up and a breakout above this trend line. I think that would likely send snap back to about 20.5, 21 to test the recent highs. In the meantime, I think you've got pretty good price support at that recent low that was established here. And so, maybe around the 1630, 1640 area, if you're looking for entry, that's where it would start to get my attention.
All righty. Let's see. How about EVR, Evercore Partners Financial Space?
All right. Nice uptrend in play until the beginning of February. I do like the fact that we came up here and took out the prior high. I just see a lot of consolidation going on here. So for me, the chart is really all about the prior move. Because when you start looking at patterns, you need a prior trend in play. Here is an uptrend, clearly. And the sideways consolidation that we have been getting, there was the high that we need to break through. And that's the double bottom. So I think right now we're simply in about a 90 to 102 trading range on EVR, with the expectation that the next big move will be a breakout to the upside.
All right. Let's see here. How about for our Canadian friends, Birchcliff Energy Limited, BIR.TO. In the energy space, of course, oil and gas producer.
Yeah, the good news is that the PPO keeps rising with each of these lows. The bad news is it continues to underperform a lot of other stocks that I'm not really a bottom fisher. I like to go with momentum. But here you can see, for instance, prices continued to decline and the PPO continues to rise. So that is a nice positive divergence. And recently on the last low, I think the volume seems to have come out of the stock. You can see the volume was much heavier back on this decline. Even in here, you can see some pretty big volume days. But recently, it seems like maybe the sellers are out of the stock. I would feel much better about this stock long term if we could clear the high that was established back in late February. If we can get back through 350, now you could take a shot as a value investor with the price where it is now with positive divergence in play. But from a momentum perspective, I think you clear the overhead trend line and also the recent high if you can get back through 350.
All right, so let's see. Next one is going to be SBLK, and that is Star Bulk Carriers, Industrial, Marine Transportation.
Yeah, marine transportation and many of these bulk shippers are extremely volatile. I know marine transportation has been one of the best areas of the market. I actually think it's one of the worst today, which is why the stock is getting hit as hard as it is. I'm a little concerned about the negative divergence that we see on the most recent price high here. So let me just quickly annotate that. But here you can see the PPO starting to roll over just a bit here. And that comes on the heels of making new highs. So that's a little bit of a bother because we had a nice uptrend, and you can even see it in the volume a little bit starting to shrink as we were moving higher. This needs to hold the 20. If it doesn't hold the 20, I think the 50-day comes in next. But I'll be honest, I've tried to trade these bulk shippers in the past, and I have troubles maybe with my technique and my strategy. They don't seem to align very well with my technical analysis skills and strategies and so forth. So I personally avoid these stocks just because, I have tried to trade them in the past and I don't usually have a whole lot of success. But what I would watch initially is that 20-day. Possibly we get down to the 50 for a reset on the PPO back to the center line.
All right. And let's see, Burlington Stores, BURL.
Yeah, this one is on my strong earnings chart list. So I'm going to go ahead and pull this one up on that relative chart. And I show this once in a while. Everyone wants to know how you set it up. So I'll just go down here. You can always come back in the recording and check it out to see how you have to do this. It's price industry and then price symbol : industry. Then with the price, it's the $ symbol : SPX. And then it's the $ industry : SPX. That's how you get this all set up, so you have all these relative ratios. But if you take a look at Burlington Stores, first of all, I love the sideways consolidation. It's trying to get another breakout. Probably could use a little bit more volume here on this longer-term daily chart. But take a look at the apparel retailers, first of all. This group's been pretty strong. Burlington is broken out relative to its peers, the apparel retailers. Burlington is actually breaking out relative to the S&P 500. And the apparel retailers are just sideways consolidating, moving along with the S&P. So the group overall has been okay in 2018, but you got one of the better performers with Burlington. So having looked at that, I think that we are in a trading range. I'll go ahead and annotate this. And it's a fairly wide one, but there are your recent highs we're trying to get through. I'm going to draw that in. I think the recent low is there, although to be honest, I really don't want to go below that last low at around 116. But these are a couple areas to watch the downside. 130, clearly we're trying to get through, but I love the volume trends and the earnings recently, the uptrend, and the fact that the overall group isn't bad. So a lot to like with Burlington.
All right, one more. Commvault Systems, CVLT. Uh-oh. There.
All right, CVLT. Well, it is breaking out, and it's in the software space. So I love the space that it's in, and it is making a breakout above the reaction high from this huge gap down. But that was a lot of volume on that gap. So I suspect we are going to see some price resistance here as we get up to the top of gap resistance. And that's going to be up close to 57 3/4 maybe in that area. So we're making a move, but I think maybe in another $1 or so, give this one a couple more percent to the upside. I would really watch. And I think if you see a tail go up above 58, so intraday highs above 58, come back down and close below it, it's probably time on a short-term basis to maybe ring that register and see if you can get back in on a pullback.
All right, and that concludes the 10 and 10. As you can see, our symbols popping up right now. I will get those up in the Market Watchers Live blog, and you'll find that from the blogs tab on our site, and look for the Market Watchers Live blog and click on it and you'll get right to that chart list link, so you're good to go. And then the blogs I do write give you the timestamps for when we actually started our segments, since they don't always start exactly on time. So, and with that, I'm going to go ahead and move us into a market update. All righty. Okay, here we go. And here's our candle glance. Right now, you can see the Dow is definitely the stronger of the major indexes we're seeing here, with a nice move up. Yes, we're getting that pullback, but you can see that it's certainly holding higher than its prior day's close, whereas the S&P 500, NASDAQ are mostly unchanged, sitting right in the middle of yesterday's close, right nearby. And then look at the Russell 2000, certainly losing ground right now. So interesting to see that strength popping back up into the Dow. I had to write yesterday about another neutral signal, a lost buy signal on the Dow. So looks like we might be starting to gain a little bit of strength now. The TSX, we're seeing the same sort of activity, a nice start in the morning, but it's now pulled back and is hovering right around yesterday's close. Treasury yields rising higher, currently reading at 2.832. UUP is on the rise, had a nice gap up and continues higher. See commodities mostly unchanged. USO is up for the day. Looks like it's forming a symmetrical triangle. Those are continuation patterns, so I would look for more upside out of USO. Gold gap down, big gap down, and is continuing lower right now, reading at 124.89 for GLD. The VIX is moving back down, looking at a reading of 16.44. And as you can see, TLT has fallen quite a bit here, but sitting right about yesterday's support level there, around 120. So we'll have to see if that will hold by the end of the day. Quick peek at our market sector, our market summary, to see which sectors are doing the best. And I'm going to scroll down here. And there you go. Industrials, not a surprise when you see the Dow showing the kind of relative strength that is today, leading technology right behind. Materials and energy are the laggards currently as far as the sector spiders. U.S. industries, transports leading the way. Computer technology as well as insurance industry groups are at the top, all three over 0.25%. Oil services, natural gas are the laggards, both down almost 2.5% for natural gas and over 2.5% for oil services. With that, I'm going to conclude the final market update and give us at least 10 minutes time to talk about our point counterpoint segment. So I guess we can kind of have a quick discussion as to what we have in mind for this.
Yeah, it's going to be a fun segment. Of course, you know, I know when I look at the market, I like to read other analysts' blogs and some of their comments and so forth, commentary. And I love having our special guests on here because it gives us a well-rounded perspective. You know, not everybody agrees with you and I, and you know, the two of us don't always agree on things. So I think it's always nice to have somebody kind of take the contrarian side of a trade or whatever. Mm-hmm. So, you know, we came up with this new idea to do point counterpoint, and we'd love through the survey at the end of the show for you to let us know what you think of it. But what we're going to do is we're going to take something that we either really like or we don't like and give the argument for that, and then the other one has to take the other side of it and come up with something to argue against, you know, either being long or short or whatever. So do you want to start it off, Erin?
Sure. Since I've got three of them up here right now, I'm going to start with Marriott. That was actually one that was requested quite a bit today. And it came up on my scan this morning. So I thought it was the perfect candidate. I really like it. The cool thing is with this is you do have to take the other side. And I personally know you would probably love this chart too. But that's going to give us that idea of how you can still find out that this is an art, because there are ways to read a chart in different ways. But I figure I picked one very bullish, so I'm going to make your job difficult here. But we have an ascending triangle, and the expectation is a breakout above that 145 line. Of course, I think the strength of this chart, seeing that oversold PMO, it's now just hit its buy signal. We have volume, hasn't done a whole lot. I might be a little, well, I'm not going to talk about it. Everything's bullish. Okay, so OBV is a little bit flat, but look at that very strong scooter. So short term, I'm just loving Marriott right now.
Okay, you're gonna put me on the spot here. The fun part about this is we didn't tell the other one what we were picking. So yeah, I am looking at this, trying to find something that I don't like, and I found something.
All right.
So on Marriott, I tell you, the thing I don't like is that when you pull up the monthly chart, and we've seen this before, we saw it back in 2013, 2014, where we were in a very similar market to what we are right now. And we had the huge move up. We had broken out after sideways consolidation, and we simply got way overbought. And that resulted, in this case, in over a year of sideways consolidation, which from a trading perspective can be an eternity. And now over the past year and a half, well, year and a quarter, we've done it again. We've moved straight up. And on a weekly basis, look at where the RSI is. We are way overbought on a monthly RSI. And as a result, I just think there's a lot of risk involved in jumping into Marriott here at this point.
All right, you did find something.
So, all right, so I'm going to take one now, and you get to counter me on this one. So I'm going to start by, and I've talked a lot about the semiconductors, and I think the semiconductors continue to be one of the strongest areas of the market. So I think, and of course, if I'm going to go back and I'm going to show you a couple things here first on the technology area. Let's go back over the last 6 months and take a look at what is leading technology. 19.5% over the last 6 months, way above many of these other sectors. So we got one of the hottest areas of the market over the last 6 months. And if you click on technology, guess what's leading over the last 6 months in technology? Semiconductors. And I happen to think the dollar is going to go higher. And as a result of that, I like the small cap semiconductors. And I'm going to pull up one that is one of the strongest out there right now, which is Cree. Now, Cree You can see on this daily chart, each time it moves higher, it's moving higher with big volume, continues to move higher. It's in a great space. I'm going to pull up that relative 1-year chart, and you're going to see this sideways consolidation, the breakout with the volume. The group itself is breaking out. CRE relative to semiconductors has been rising now for the past 6 months, or excuse me, 6 weeks. And that's when the dollar bottomed. So I think that this outperformance by a small cap semiconductor is likely to continue. And the semiconductor is one of the strongest areas in the market, breaking out again relative to the S&P 500. So I like CRE. What do you have to say about that one?
Oh gosh, that's a hard one too, because in all honesty, I do like it. And I agree, great space to be in.
No, you can't agree. You got to disagree.
I know I'm not, but I won't agree, but I'm going to show you all the reasons why you're wrong.
Okay.
So I can still do that.
Okay.
So anyway, I pulled it up on the daily chart. I noticed on yours, and I don't follow candlesticks very much, but one of the things I do know is that this candlestick right now today is not good. You do not want to see a huge tail right after you've broken out from a very bullish pattern. So that bothers me. And again, I'm not a big candlestick follower, but even on a OHLC bar, that would concern me. And looking at the weekly chart here, there we go. I think you can talk about it's hitting some very important resistance right now. Let's get that in there. I don't know why my resolution just kind of went away. So I'm looking up here at some possible overhead resistance forming at the low really that we had here back in April of 2014, and the top that formed pretty much the top of a flag, and it took off. So I think, and you can see we're just now hitting that $45 level of overhead resistance, and it has turned back down. Remember, we've got that long tail. So that'll be my counterpoint on CRE.
All right, well, I have to hand it to you, because when I looked at it, first of all, when I came up with this stock earlier today, the candle did not look like that.
Figured.
It was looking much more bullish. And as soon as I pulled it up and I saw it on the screen, I was like, oh my gosh, that candle. I said, that candle looks horrible. And then I thought, well, that's okay. Erin doesn't use candlesticks.
I know, right? But that one I do know, that I do recognize. Those and hammers I do kind of pay attention to, because they're pretty much, they're pretty good indicators for the next day or two. I do like that. Okay, let's try, what's my other one here?
Yeah, we probably got time for one more.
Yeah, how about steel, in steel? And I'm going to take a negative view on it right now because it's in a declining trend. But there, you might be able to find something positive here on your chart. But I'm looking at in steel industries. I'm going to take a bearish position. It's been in a declining trend channel. And I'm just now getting these neutral signals on the short-term and intermediate-term trend models for decision point. I don't like the fact that, it failed back here. We've had the PMO falling and confirming with these lows and matching the lows on price. And look at this PMO. It's reached its signal line and is turning back down below the zero line. So not liking in steel industries, and IIIN. Pass it to you.
Wow. Okay. This one is going to be a little tough for me. But I got something. Something. Let me pull my screen up here. And let's start with the daily chart. So what I like about in steel is that, number one, we were in a nice uptrend, very solid volume trends. And yes, we've been pulling back, but notice the volume has been a lot weaker to the downside. So I do think that there's accumulation taking place in the stock. I also like, I'm going to annotate this, but I do like the fact that we got this nice reversing candle right here on the bottom. That's a bullish engulfing candle off this downtrend that led us back up to the upside. So I think on a daily basis, I would be watching the support level, but as long as that holds, I'd be okay with it. And then what I wanted to do was to take a look at the weekly chart. Oops, that's not what I wanted. All right, let me pull it back up again. All right, let's take a look at the weekly. And on the weekly chart, a couple of things stand out to me. Number one, long-term price support pretty much held. I mean, we did come down like for a triple bottom here. While we didn't hold on a closing basis, you can see that we absolutely held all of this selling that took place on very heavy volume back in the latter part of 2016. And so that area has been very strong. We moved back up. Look at the failure at the 20-week. Well, we finally made it back up above that 20-week. And as we pull back, we're now testing it. And here again, I just showed you the reversing candle on the daily chart. This is a piercing candle on a weekly chart, right at the 20-day moving average. Last high, we saw the PPO rising. So I think momentum, price momentum on a long-term basis has been accelerating. And this pullback, as you can see down here, is on much lighter volume. So I actually think that it presents a pretty solid reward to risk trade using this weekly chart.
Ah, see? Very fun. Now you get to throw one more at me, and then we'll close and wrap this up. I'll go very quickly.
All right. Well, I'm gonna shock you with this one.
Oh, excellent.
I'm pulling up GE.
I almost did that one.
I'm not. Well, all right. I got to take a stance. I'm going to say I'm getting bullish on GE. I think we had all of this selling that took place on huge volume to the downside. It has been moving lower and lower, but I'm seeing the volume come out of it. 2 days ago on Tuesday, there was someone came out, one of the big houses came out and said GE's dividend is still in, it's still up in the air. And we did pull back, but I think that reaction was very muted to what I think was pretty bad news on a stock that's been absolutely trashed for a while. I think it's bottoming and starting to turn back to the upside. So I think GE is getting to a point for value investors where it's a buy.
Wow. Okay. Let's see. I'm going to grab that screen back. So I need to be bearish here. And yeah, I was looking at this one to do exactly what you're doing. Take a bullish stance.
No, you got to get rid of those thoughts.
I know.
All your bullish thoughts.
All away. Yes. All right. So I mean, let's face it, there are plenty of negatives here on this chart. So I still am not liking it so much, but like I said, I can see your point. I'm going to be nice about it. But we're in this declining trend, and notice that the last time we did kind of break out of this consolidation zone, we just barely did. Of course, it was kind of that long tail there gave us that information, but notice that it failed to even test this declining tops line, and it's just not getting out of that consolidation zone. Look at the OBV volume, and then also a scooter that has been flatlined really most of the year, but really since December, it's been about as low as you can be relatively to any of the other large cap stocks. So I don't like it. I don't think that we're where we need to be yet on GE to make it a good choice. So I'm going to do that.
There you have it.
Here are the stocks we discussed and took two different sides to. And yeah, I think it really does point out that you can read a chart almost any way you want to. So that's why it is helpful to kind of know what's behind it, because I think any analyst out there, if they felt like it, could just take whatever position they want and prove their point using whatever select indicators they have.
Well, I took a course many years ago. It was probably I think it was 2005 or 2006. And the name of the course was Mind Over Money. And it talked a lot about the psychology of trading and how, as humans, we have the natural instinct to always want to be right. We always want to prove ourselves right. And the whole point was that you have to kind of overcome that when you're trading, and you have to admit sometimes that you are wrong. And so when you take two different sides, the market's constantly made up of people who want to buy or want to sell, taking both sides of the argument. I don't think the success comes from how many times you're right or how many times you're wrong. To me, it's about managing your risk.
Yes.
And being able to acknowledge that, yes, I made a mistake. It's not doing what I thought it was going to do. And when it breaks down, you get out. Yeah. Or if it breaks out, if you're shorting and it breaks out, you get out. So I think there's a lesson to be learned in that
Yes.
So I think it's a
Avoid
great.
wishful thinking too.
Yeah.
That would be my other advice. If you have a loser, you know what? Just take the hit. Don't hold on to it with hopeful, wishful thinking. You're just going to watch it go further down. I can just tell you from my experience, that's almost always the case. So
And this poll that's up right now, this is pretty
very
I mean,
interesting.
it's kind of what's right in line with what I thought. I figured most of the folks here were shorter term, not day traders, but shorter term, and with a good mix of intermediate traders. Notice down at the bottom, the day trader and the really long buy and hold are a very small minority of the people that responded.
Yeah, about a third of them are intermediate. I would have expected a bit more in the day trading because I know all of the information we do is pretty fresh, and honestly, it doesn't have necessarily a lot of shelf life. So
Yep. Well, there you go. There's the point, counterpoint, the symbols we had. And now with the upcoming schedule, take it away, Erin.
all right. So we've got my workshop tomorrow. I got to do some homework after I sign off here on volume indicators. Everything stock charts will start the week on Tuesday. Chip or Grayson or I'm not sure, Bill Shelby. And then we have special guest David Keller, CMT, and he will be here to talk about his thoughts on the market. Looking forward to that.
All right. And I do want to point out just below your chat area, there is a how'd we do section. Fill out that survey if you don't mind. It's a link to just a very brief one question survey. We'd like to hear what you think of Point Counterpoint. That was a new segment we introduced today. And I thought it was fun, and it would be fun to, have a guest on sometime, maybe sound off kind of a segment that we did a week or two ago.
Oh, they can pick the winner.
There you go.
You had the best argument. I don't agree with it, but
anyway, want to thank everybody for stopping by. We always enjoy having you with us. Please remember, as I said, to complete that survey as you exit. We'd like to get your feedback. Hear what you think of Market Watchers Live, and in this case, what you thought of our new segment, Point Counterpoint. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here on Friday. Take care and happy trading.